Gentlemen, welcome back. You're back with MGTOW Money. Because I firmly believe that ignorance is not bliss, I've got some more investing vocabulary to help you make more money and be a better investor. Before we get to that, though, let me quickly comment on the last video. For whatever reason, the reasons that I'm baffled by, our good friends at Google have decided that the video and some of the content is not necessarily appropriate for all of their advertisers, and therefore I'm going to guess they are going to pull all the ads. And they have chosen already to do that with, unfortunately, multiple other videos that I have done due to questionable content, I suppose. I will leave that where it is. Next, if for whatever reason you're not being notified about new videos being released here, please go to Twitter and follow me on MGTOW Money, and I will drop you a note when new videos become available. Let's move on to today's topic, more investing vocabulary. Let's get started with something I wrote up. The U.S. dollar was weaker in overnight currency markets, especially against the Japanese yen, as Prime Minister Shinzo Abe said exports were strong, and he further expected this to support the country's increasing GDP. He further stated he expects inflation to remain subdued throughout this calendar year. Analyst Joe Blowhard had commented the weak dollar would probably support precious metals, especially gold, and suggested taking a position in the futures or options markets for potentially strong gains over the next couple of months. All right, gentlemen, what did we hear there? What did we get? First, we heard about the Forex markets. We're talking, of course, about the foreign exchange currency market. Your home country has a currency. Assuming that it's not a managed currency, it trades 6 days a week, approximately 24 hours a day, 6 days a week, against another country's currency. Very predominantly, most currencies will trade against the U.S. dollar. The U.S. dollar trades against just about every single currency in the world, again, that is not a managed currency. I won't get into all the details about using Forex and why you might want to trade Forex, etc., other than to say one thing that's fantastic about Forex is that it has huge leverage. This can be a very, very good thing insofar as you can put up $1,000, let's say, $1,000 and be able to control, let's say, an equivalent of $20,000 in euros. So, for example, if you are long the US dollar versus the euro, they move in a teeter-totter type fashion. One goes up, one goes down. So you're long, you're bullish, you're expecting the US dollar to go up, the euro to go down, and you're doing a 1-to-20 ratio, and the dollar does go up, and you prove right, you can make a lot of money. But guess what? Correspondingly, it can work against you, and you can end up losing a lot of money. So I'm, again, not going into all the details. If you have any interest in this is a gambling type thing, purely for our speculators, for our gamblers out there. You might want to take a look in Forex trading. It is highly risky. Probably 95% of people that trade Forex end up losing money, or certainly at least 90%. Let's just say that. Moving on next, commodities. These are traded across the world. They include things like wheat, oats. You might hear about various meats like cattle, pork bellies. That's something rather esoteric that's traded. Lumber, that's something else. Gold, silver, also the base metals, for example, lead, zinc. These commodities are traded across the world on a commodity exchange. For example, in the United States, the CME trades these commodities. It's also known as a futures exchange. And you can trade these things just like you trade a stock, just like you trade a bond. You can make a bet that it's going to rise. You can make a bet that it's going to fall. And just like we were just talking about with Forex markets, there can be huge leverage involved here. So again, you can make a lot of money or you can lose a lot of money very, very quickly. And I'm speaking from personal experience about that. Next, the fixed income market. The fixed income market, another term that you might hear, is the bond market. I did an entire video about bonds. I'll include a link in the show description about very basic information on bonds. Again, fixed income, just know we're talking about bonds. We're talking about whether they be government bonds or corporate bonds. And I also want to throw in a subset of this that actually has done very, very well this year are high yield bonds, also known colloquially as junk bonds. Just because they're called junk bonds doesn't mean that they're garbage or something you don't want to be involved with. These typically have a higher interest rate due to the level of risk that is presumed or at least perceived to be in them. Again, people have done very, very well, especially over the past 12 to 24 months. I know there was a commenter in the comments some videos ago who talked about how he did very, very well in the high yield market. Yes, you can make money with junk bonds. Again, speaking from my own personal experience. Next, GDP. GDP stands for Gross Domestic Product. Essentially, this is a measure of all the goods and services at a particular time, whether it be on a quarterly basis or an annual basis for a particular country. As I've mentioned in prior videos, on an aggregate basis, the United States, percentage-wise in the world, makes up about 20 to 25% of the world's GDP. However, the United States is definitely not, when you break it down in terms of, for example, a per capita, per spending type, cost of living type issue, the GDP in the United States is actually, the United States ranks fairly low. A country like Qatar, a country like Norway, a country like Singapore that has a smaller population actually has a higher GDP on a per person, per capita parity basis. Next, inflation. Inflation in simple terms, again, without getting into all the details, is simply reflected in rising prices. It doesn't necessarily mean rising consumer prices. In other words, gasoline's going up, that means inflation. Yes, it does mean inflation. Food's going up, well, that means inflation. Yes, that is, again, symptomatic of inflation. However, that isn't necessarily mean other things can't also go up. We've seen asset prices, in other words, stock markets across the world, in particular over the past 12 months or so, rise many people at least argue that that is another symptom of inflation. Correspondingly, on the other side, you have deflation reflected in falling prices. In other words, we've seen cell phones fall in price. We've seen other commodities, a la the price of oil, has been falling in price. That is symptomatic of deflation. I won't get into all the ideas of what causes inflation, etc. That's a very long, convoluted topic, and no one actually is conclusive exactly what does cause it. There are three main schools of thought, though. There's an Austrian school, there's a Keynesian school, and there's the monetarist school. Which is right? I don't know. They all have their different ideas about it. Let's move on to another one, a stop loss. I encourage you, gentlemen, whether you use a mental stop loss, and I've talked about this before, or you actually put in a stop loss, in particular when you're buying a stock or a cryptocurrency that sort of sets a floor. So, for example, if I buy a stock at $10, and if that stock goes down 10% to $9, for example, I can put a stop loss in with my broker indicating if it drops to 9, I want out of that stock. I want to be done with this investment because it could go 8, 7, 6, etc. You can also use a stop loss on a trailing stop basis. I talked about this a couple of videos ago. I just want to flesh out a little bit more in detail. If you have something that's appreciating in your favor, again, you've got that stock, you bought it at $10, now it's gone to $15. You can use a trailing stop, again, just like I was talking about before, where you can put it at $13, for example. If it trades down to 13, at least you've picked up that 30% profit using a trailing stop loss. Next, options. Options are sort of a close cousin to futures commodities that I was talking about, where again, you can trade things like grains, meats, metals, etc. However, you're doing so on a more long-term basis and you're still using leverage. However, the leverage just isn't quite as much. Just be aware, options are simply a way of betting whether something's going to rise or going to fall in price. You'll hear the term calls and puts. Calls being you're betting something's going to rise, puts being something is going to fall. Call up, put down. Next, the VIX. The VIX is something that's been talked about a lot this calendar year because the VIX has been falling dramatically. The VIX is an index, kind of like the S&P 500, but what it does is it measures volatility in the stock market. It measures how much are stocks rising and falling falling in a particular day or in a particular time frame. And the stock market, although it's been rising, has been doing on a very quiet sort of way, at least in the United States, and has been doing a little bit more dramatically overseas, in particular in emerging markets. But again, the VIX is simply an index of volatility in the market. This market across the world, but in particular in the United States, has been a very quiet market. So the VIX is very, very low right now. Is that going to continue? I wouldn't bet on it. I would bet the odds are that volatility is going to increase, and I personally would be considering about going long the VIX, not short the VIX. In other words, I would expect that the VIX is going to increase, the volatility will increase. Next, sectors. When we talk about sectors, we're talking about specifically sectors of the stock market. We're just simply talking about groups of stocks in a particular category. For example, there's an energy sector. So in the energy sector, we're going to talk about companies like ExxonMobil, Total, the French company, Chevron, etc. If you want to talk about the technology sector, we might talk about Intel. We're going to include Dell. Maybe we'll throw in Amazon, etc. Maybe we're going to talk about the consumer staples sector. So, for example, we're going to include companies like Procter & Gamble, Palmolive, etc. All right, let's move on to the last one, drawdown. Drawdown is absolutely critical. I've mentioned this before. I need to define it even more so to make sure that everyone's doing it. Whenever you're looking at an investment, it is absolutely critical that you always consider the drawdown. What is, at least historically speaking, what is the maximum amount, percentage-wise or dollar-wise, that this particular investment, that this particular asset, hopefully it's an asset, has dropped in value? So, for example, in the United States, the Dow Jones Industrial Average at one point dropped from peak to trough over 80%. So in other words, if you had $1,000 at one point at the peak, it went all the way down to approximately $200. It was less than $200 actually. And this was during the Great Depression. We've already seen in the 2000s, if you will, in the past 17 years or so, twice where the overall stock market has dropped over 50%. So again, you had $1,000 in the stock market, its value was less than $500. That is the drawdown. That is a critical measure, an historical measure, albeit, but gives you an indication of how far an investment can fall. Because this can be very important as you're making plans, and in particular, if you have some sort of target date for financial independence and for retirement, etc., you need to know how bad could things get. So therefore, you're going to necessarily need to adjust your asset allocation depending upon what your goals are in the future. All right, gentlemen, I hope you found that educational. Now, join the MGTOW Money Army now. Smash the PayPal and Patreon button in the description, in the video description, because we're moving this forward, and buy me a cup of coffee. As always, John Galt out.